Richer, Wiser, Happier by William Green. Introduction. It's 7 in the morning on Christmas Day. In the smoggy, rising sun of Mumbai, a man named Manish Pabri steps into a minivan. He's a long way from his home in California. He's traveled here not for a holiday, but for a very specific purpose. After hours of driving through the chaotic, horn-blaring streets of India, past sites that seem to belong to another century, he arrives at a rural high school. Waiting for him are 40 teenage girls. These girls come from families that survive on less than $2 a day. They belong to the lowest castes of Indian society, the so-called untouchables, and for them, the world has very few doors open. But Manish, one of the most successful investors of our time, has built a special key. His foundation, Dakshana, finds the most gifted children in these forgotten corners of the country and gives them a chance. It prepares them for a notoriously difficult entrance exam to India's top engineering colleges, a test that over 1 million students take, but less than 2% pass. Dakshana's success rate? Over 60%. As Manish walks into the classroom, he breaks the ice with a tradition. He poses a single, incredibly difficult math problem. He writes it on the chalkboard: $n is a prime number greater than or equal to 5. Prove that $n squared minus $1 is always divisible by 24. He tells the girls that everyone who has solved this problem has gone on to win a place at the elite colleges. He doesn't expect anyone to solve it today. It's just a way to gauge the raw talent in the room. The girls get to work. 10 minutes pass. Manish asks, "Is anyone close?" A 15-year-old girl named Elisa quietly says, "Sir, it's only a theory." She's hesitant, her confidence fragile. But Manish invites her to the front. She hands him her paper, her head bowed, waiting for the verdict. He looks at it, and a smile spreads across his face. "It's correct," he says. He tells her she solved it so elegantly that she could rank in the top 200 in the entire country. "You're a sure shot," he says. In that moment, something magical happens. A child, plucked from the deepest poverty, has just proven she has the mental firepower to change her destiny, and her family's, forever. Later, one of the students gathers the courage to ask him the question that's on everyone's mind. "Sir, how did you make so much money?" Manish laughs. "I compound money," he says. He then asks them a question of his own. "I have a hero. His name is Warren Buffett. Who here has heard of Warren Buffett?" Not a single hand goes up. So he tells them a story, and it's a story I want to share with you today. It's a story about a hidden world, a world of thought inhabited by the greatest financial minds of our time. And it's the story at the heart of a remarkable book by William Green called Richer, Wiser, Happier. This isn't just a book about how to get rich. It's much deeper than that. William Green spent 25 years interviewing these legendary investors, people like Sir John Templeton, Charlie Munger, Howard Marks, and many more, and he discovered something profound. He found that their success wasn't just about formulas or stock tips. It was about a way of thinking. A set of mental habits and principles that allowed them not only to win in the markets, but to win in life. By the end of our journey today, you will have learned the core principles that these masters of the universe live by. You will understand how they think about risk, how they make decisions when the future is unknowable, and how they build lives filled with meaning that goes far beyond money. This is more than a summary. It's an invitation to peek inside the minds of the greatest investors who ever lived and borrow the tools that made them richer, wiser, and happier. Book summary. So, where do we begin our journey into the minds of these financial titans? We start with a simple, almost shockingly powerful idea. It's the very first lesson that Manish Pabri, the man we met in that classroom in India, learned when he set out on his quest. It's the idea of cloning. You see, Manish wasn't born into the world of high finance. He grew up in modest circumstances in India, the son of a wonderfully optimistic but perpetually bankrupt entrepreneur. He says, I watched my parents losing everything multiple times. Not having enough money to buy groceries tomorrow, but he also saw that it never broke their spirit. His father used to say, "You could put me naked on a rock and I will start a new business." This taught Monish resilience, but it also gave him a deep desire to avoid that kind of financial precarity. After moving to the United States for college, he started a successful IT consulting company and, by 1994, had saved his first $1 million. He was ready to invest, but he knew nothing about the stock market. Then, one day, waiting in an airport, he picked up a book by the legendary investor Peter Lynch. And in that book, he read a name for the first time: Warren Buffett. He was astonished to learn that Buffett had been earning returns of over 30% a year, year after year, for decades. Monish did the math. He understood the awesome power of compounding, the idea of earning returns on your returns, creating a snowball of wealth that grows exponentially. He realized Buffett had turned a small sum of money into a colossal fortune simply by being a master of this game. And right there, a light bulb went on. Monish thought to himself, what if I could figure out exactly how Buffett does it? What if I could just copy him? This wasn't about a lack of imagination. It was about a profound sense of humility. As Charlie Munger, Buffett's brilliant partner, once said, "I believe in the discipline of mastering the best that other people have ever figured out. I don't believe in just sitting down and trying to dream it all up yourself. Nobody's that smart." Monish embraced this philosophy with a passion that bordered on religious fervor. He calls it cloning. He says, "I'm a shameless copycat. Everything in my life is cloned. I have no original ideas." Think about how radical that is. In a world that celebrates originality and innovation, he argues that the smartest path is often to shamelessly borrow the best ideas from the best people. He devoured everything he could find about Buffett, every shareholder letter, every biography, every interview. And he realized that Buffett and Munger had essentially laid out the laws of investing, which were as fundamental as the laws of physics. And what were these laws? They were surprisingly simple. First, when you buy a stock, you're not just buying a ticker symbol on a screen. You are buying a piece of a real business. Your job is to figure out what that entire business is worth. Second, the stock market is not a wise, all-knowing machine. It's more like a moody, manic depressive business partner, whom Ben Graham, Buffett's mentor, called Mr. Market. Some days, Mr. Market is euphoric and will offer to buy your shares at a ridiculously high price. Other days, he's terrified and will offer to sell you his shares at a ridiculously low price. You are free to ignore him. But his mood swings are your opportunity. Third, and this is the most important rule of all, only buy when you can get a business for far less than it is conservatively worth. This gap between the price you pay and the underlying value is what Graham called the margin of safety. It's your protection against bad luck, your own mistakes, and a future that is fundamentally unknowable. As Buffett says, when you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. The margin of safety is that same principle applied to investing. Monish saw that most professional money managers were breaking these laws every single day. They owned hundreds of stocks, traded them constantly, and paid far too much for them. He saw it as a game where most of the other players didn't even know the rules. So how do you win the game? He asks. You've got to play according to the rules. And so, Monish became a cloner. He cloned Buffett's investment philosophy. He even cloned the fee structure Buffett used in his early partnerships, charging no management fee and only getting paid if his investors made a decent return. It was an honorable way to do business, aligning his interests perfectly with his clients. This strategy of cloning made him phenomenally successful. From 2000 to 2018, his fund returned over 1,200%, crushing the market. So why don't more people do this? Monish has a simple answer. They're not as shameless as me. They have more ego. To be a great cloner, you have to check your ego at the door. Cloning is a powerful idea, but it's not the only path to success. In fact, some of the greatest investors took the exact opposite approach. They succeeded not by following others, but by having the courage to stand completely and utterly alone. This brings us to a man who William Green describes as probably the greatest international investor of the 20th century, Sir John Templeton. Picture this. Green is on a reporting trip in the Bahamas, walking along a beautiful beach. He stumbles upon a peculiar sight. An old man is immersed up to his neck in the ocean, wearing a long-sleeved shirt and a ridiculous-looking hat with ear flaps, his face smothered in sun cream. For 45 minutes, he power walks against the resistance of the water. Green later realizes this man is the legendary Sir John Templeton. And that image? Of a billionaire marching through the surf in a comical hat, completely indifferent to what anyone might think, was a perfect metaphor for his entire life and investment philosophy. Templeton possessed what an investment expert once called the willingness to be lonely. He had an inner conviction that allowed him to take positions that others thought were crazy. He was a true maverick, an iconoclast who saw the world differently from the crowd. This willingness to be lonely was forged in his childhood. He grew up in a small town in Tennessee, and he couldn't remember his parents ever telling him do this or don't do that. They wanted him to become self-reliant. When he was just a boy, they made him the navigator on a family road trip. He misread the map and took them hours in the wrong direction. Nobody corrected him. They just waited until he figured out his own mistake. This, he said, was a marvelous education. He carried that independence with him his entire life. And it led him to make what might be one of the boldest and most prescient investments in history. The year was 1939. Hitler had just invaded Poland, and the world was plunging into war. Stock markets were crashing. Despair was everywhere. Most people were fleeing to the safety of cash. But Templeton, a young man in his 20s with almost no investing experience, asked himself a simple, contrarian question: if there's any time when every product is in demand, it's during a war. He reasoned that even the weakest American companies, many of which were on the brink of death after the Great Depression, would likely be revived by a surge in wartime spending. So, he did something audacious. He asked his stockbroker to buy him $100 worth of every single stock on the New York Stock Exchange that was trading for $1 or less. There were 104 of them. His broker called back, saying they had eliminated 37 of the companies because they were already in bankruptcy. Templeton's reply was telling. "Oh, no," he said. "Don't eliminate those. They may recover." He was so confident, he borrowed $10,000 to fund the bet. Think about the courage that took. The future had never looked so bleak. But as Templeton saw it, so much bad news was already priced into the market that the odds were overwhelmingly in his favor. It was, as he said, common sense arithmetic. He held those stocks for years, through the darkest days of the war, even as the drumbeat of disastrous news grew louder and louder. When he finally sold, he had made a profit on 100 out of the 104 companies. He had turned his $10,000 into roughly $50,000. It was a triumph of both intellect and character. He had the courage to buy at what he would later call the point of maximum pessimism. Templeton's core principle was simple: to buy when others are despondently selling and to sell when others are enthusiastically buying is the most difficult. But it pays the greatest rewards. He searched the globe for bargains, constantly asking, where is the outlook worst? Because that's where he was most likely to find fear, and where there is fear, there is often opportunity. Decades later, during the Asian financial crisis of 1997, he poured millions into the battered South Korean stock market, which was the most hated investment on earth at the time. A fund that tracked Korean stocks had lost 65% of its value in a single year. Templeton became its largest shareholder. Within 2 years, that fund had risen 266%. He was the ultimate contrarian. While Manish Pabrai found success by cloning a master, Templeton succeeded by thinking entirely for himself. He forged his own path, guided by logic, self-reliance, and an almost defiant indifference to the opinion of the crowd. So we have two paths, cloning the best, or standing alone. But what happens when the very ground beneath our feet is constantly shifting? How can we make smart decisions when the world itself is in a state of constant, unpredictable change? This brings us to our third great thinker, a man who built his entire philosophy on this single, profound truth, Howard Marks. When Howard Marks was an undergraduate, he took a class on Japanese Buddhism. It was there that he encountered a concept that would shape his entire view of investing in life, mujo, or impermanence. Change is inevitable, he says. The only constant is impermanence. We cannot expect to control our environment. We have to accommodate to our environment. We have to expect and go with change. For an investor, this is a deeply awkward truth. Investing is all about making bets on the future. But how can you do that if the future is unknowable and the present won't last? This, Marx says, is the biggest problem in markets. Most people deal with this by pretending they can predict the future. They listen to so-called experts on TV who confidently forecast where the stock market will be at the end of the year. They build elaborate spreadsheets that give them the illusion of certainty. Howard Marks, a billionaire who oversees more than $120 billion in assets, is a staunch member of what he calls the I don't know school of thought. He believes the future is influenced by an almost infinite number of factors, and so much of it is just random, that trying to predict it consistently is a fool's game. He loves to quote the economist John Kenneth Galbraith, who said, "We have two classes of forecasters, those who don't know, and those who don't know they don't know." So, if you can't predict the future, what can you do? This is where Marx's genius lies. He teaches that instead of trying to predict, you must prepare. And how do you prepare? First, you have to understand that almost everything in markets is cyclical. Economies expand and contract. Investor psychology swings like a pendulum, from euphoria to despair, from greed to fear. Nothing goes in one direction forever. The problem is, most people act as if the current trend will continue indefinitely. When the market is soaring, they forget it can ever fall. When it's crashing, they forget it can ever recover. Marx says your job is to figure out where we are in the cycle. Are investors being appropriately skeptical, or are they ignoring risk and paying crazy prices? Is there too much optimism in the air? He doesn't try to predict when the cycle will turn. He believes that's impossible. But by understanding the present mood, he knows whether to be aggressive or defensive. It's like driving more carefully on an icy road at night than on a sunny afternoon. You adapt to the conditions. Second, because you can't know the future, you must always insist on a margin of safety. Like Graham and Buffett, Marx believes that the single most reliable route to investment riches is buying things for less than they're worth. The question he is always asking is it cheap? And more subtly, how much optimism is already baked into the price? If the price of an asset already reflects a perfect, rosy future, it's a dangerous bet, because the future is rarely perfect. Marx put this philosophy to the ultimate test during the 2008 financial crisis. In 2007, a year before the crash, he wrote a memo to his clients identifying a slew of danger signs. He saw idiotically loose lending standards, a carefree willingness to finance undeserving companies, and a general lack of fear. He didn't know what would trigger a crisis, but he knew the system was vulnerable. So Oaktree, his firm, prepared. They raised the biggest distressed debt fund in history, nearly $11 billion, and waited. They were like a fire department, ready for the alarm to sound. When the crisis hit and Lehman Brothers collapsed in September 2008, the world went into a panic. The financial system was on the verge of melting down. But as pessimism exploded, Marx turned bullish for the first time in years. On the very day Lehman died, Oaktree began investing, pouring $500 million a week into the busted assets that nobody else would touch. He didn't know for sure that the world wouldn't end. But he made a simple, calculated bet. He wrote to his clients, "Most of the time, the end of the world doesn't happen. And if it doesn't end, and he didn't buy when assets were being given away, he wouldn't be doing his job." Later, in the depths of the panic, he had a meeting with a pension fund manager who was terrified of losing more money. No matter how much Marx reassured him, the manager kept asking, "What if it's worse than that?" Marx raced back to his office and had an epiphany. For years, he'd warned investors to be skeptical when optimism was rampant. But now, pessimism had reached such an extreme that investors acted as if no story was too bad to be true. And he realized a profound truth: skepticism calls for pessimism when optimism is excessive. But it also calls for optimism when pessimism is excessive. Howard Marks, the eternal worrier, became virtually the only optimist on Wall Street. Oaktree invested about $10 billion in the depths of the crisis and made an estimated profit of $9 billion. It was a masterclass in assessing the environment, accepting reality, and acting with clear-eyed logic when everyone else was consumed by emotion. The lessons from Monish Pabrai, Sir John Templeton, and Howard Marks give us a powerful foundation. We've learned to clone genius, to stand alone, and to navigate an uncertain world. But what about building something that lasts? How do you construct a financial fortress that can withstand not just one storm, but the inevitable turmoil of a lifetime? This brings us to the quiet, cautious world of Jean-Marie Eveillard and the concept of resilience. Eveillard was born in France in 1940, just months before the German invasion. He grew up hearing sermons in his grandmother's church that this world is a valley of tears. This wary, fretful view of life primed him perfectly for the teachings of Benjamin Graham. Like Pabrai, Eveillard had a moment of conversion when he discovered Graham's book, The Intelligent Investor. He was illuminated by one core message: because the future is uncertain, your number one priority must be to minimize your risk. This seems obvious, but most people get it backward. They focus on maximizing their returns. They chase the hot stock, dreaming of huge gains. Eveillard, following Graham, focused first and foremost on not losing money. He knew that if you lose 50% of your capital, you need to make 100% just to get back to even. The math of loss is brutal. So, for decades, he ran his fund with a singular focus on the margin of safety. He scavenged the globe for stocks that were trading for at least 30 to 40% less than his conservative estimate of their value. And he owned a lot of them, often more than 100, because, as he admits, "I'm too skeptical about my own skills." This cautious approach worked beautifully. For 18 years, he beat the market with low risk. His worst year was a tiny loss of just 1.3%. Then came the late 1990s, and the dot-com bubble. The market went insane. Tech stocks with no profits were soaring to absurd valuations. Eveillard, the man who fretted for a living, refused to participate. His portfolio contained 0 tech stocks. And for 3 long years, he suffered. While the Nasdaq was rocketing up, his fund was going nowhere. His shareholders, who had once praised his prudence, were now furious. "After 1 year, your shareholders are upset," he says. "After 2 years, they're furious. After 3 years, they're gone." He lost 70% of his clients. His bosses at the bank that owned his fund grumbled that he was half senile. He began to doubt himself. "There were days when I thought I was an idiot," he confesses. "Everybody seems to see the light. How come I don't see it?" In early 2000, Julian Robertson, another legendary value investor, gave up. He closed his funds, complaining that in an irrational market, logic does not count for much. But Eveillard struggled on. He couldn't bring himself to abandon the principles that had guided him for so long. Finally, his company found a way to get rid of him. They sold his fund group in January 2000. 2 months later, the tech bubble burst. As rationality returned to the market, Eveillard's portfolio of bargain-price stocks performed superbly. He trounced the market for the next 3 years. Morningstar, The fund rating agency named him Manager of the Year and later gave him a Lifetime Achievement Award for his courage to differ from consensus. The investors who had fled came flooding back, and the bosses who sold his business at the bottom were left, as he says, eating their balls. Evear's story teaches us a critical lesson about resilience. It's not enough to have a sound intellectual framework and the emotional fortitude to stick with it. You also have to be in a position where you can survive long enough for your strategy to pay off. Evear was almost destroyed not by the market, but by the short-term pressures of his clients and his bosses. This is why Buffett structured Berkshire Hathaway the way he did. It's not a fund, it's a public company with permanent capital. No one can pull their money out in a panic. He built it to be a fortress, ensuring he would never have to depend on, as he puts it, the kindness of strangers. For us as individuals, the lesson is clear. To be resilient, we must always keep a cash reserve so we're never forced to sell in a downturn. We must avoid excessive debt, which erodes our staying power, and we must resist the temptation to speculate on hot stocks that offer no margin of safety. Our goal should not be to get rich quick, but to build resilient wealth that endures. Now, all these ideas, cloning, being a contrarian, preparing for uncertainty, building resilience, can seem quite complex. There are so many rules, so many things to consider. What if there was a simpler way, a path to stellar returns that cuts through all the noise and complexity? This question obsessed our next investor, a man who has spent his entire career on a quest for the ultimate sophistication, simplicity. His name is Joel Greenblatt. When Greenblatt was a student at the prestigious Wharton School of Business, his professors taught him the efficient market theory. They claimed it was pointless to try to beat the market because all available information is already reflected in stock prices. The only rational thing to do, they argued, was to buy an index fund. Greenblatt didn't buy it. He had a visceral response. He saw investors all around him acting emotionally, driven by fear and greed. He saw the manic-depressive Mr. Market that Ben Graham wrote about. The market didn't seem very efficient to him. He realized the secret of successful stock picking could be boiled down to one simple idea, the same one Graham and Buffett championed: figure out what something is worth and pay a lot less. Is it really that straightforward? Greenblatt believes it is. He tells his students at Columbia Business School that if they do a decent job of valuing businesses and buying them at a steep discount, he guarantees the market will eventually reward them. In 90% of the cases, he says, the market will recognize that value within 2 or 3 years. Why? Because, eventually, Mr. Market gets it right. Greenblatt became a master at finding what he calls unfair bets, situations where the potential upside massively outweighed the downside risk. Like Manish Pabrai, he loved bets where it was heads, I win. Tails, I don't lose much. He found these opportunities in the forgotten corners of the market, in offbeat places where other investors weren't looking. One of his favorite hunting grounds was corporate spin-offs. This is when a company gets rid of a division by turning it into a new, separate company. Often, the parent company keeps the attractive part of the business and spins off the toxic waste. These new, spun-off companies often look horrible. They might have a lot of debt or be in a bad industry. Most investors want nothing to do with them. And that's precisely why Greenblatt loves them. The way you're going to find bargains, he says, is by searching for hidden value in assets that other people don't want. He found a perfect example in 1993, when the Marriott Corporation announced it was splitting in two. It would create Marriott International, a beautiful hotel management company, and spin off a company called Host Marriott, an ugly duckling that would hold all the debt-laden real estate. Everyone wanted to own the beautiful swan. No one wanted the ugly duckling. Greenblatt, naturally, zeroed in on the ugly duckling. He did his homework and realized that the man who had orchestrated the deal, a financial wizard, was choosing to run the ugly company. That was a big clue. He dug deeper and discovered that, despite its ugly appearance, the business was worth far more than the market was giving it credit for. He made an aggressive bet. He says, I don't buy more of the ones I can make the most money on. I buy more of the ones that I can't lose money on. He saw very little downside. Within 4 months, Greenblatt tripled his money as the ugly duckling took flight. But Greenblatt's search for simplicity didn't stop there. He wondered if he could distill his entire philosophy into a formula so simple that anyone could use it. This led him to create the magic formula. He wanted a way to find good companies at cheap prices, automatically. So he chose 2 simple metrics. To find a good company, he looked for businesses with a high return on capital. This is just a measure of how efficiently a company turns its assets into profits. To find a cheap company, he looked for businesses with a high earnings yield, which is a way of measuring how much profit you get for the price you pay. He then back-tested this idea. What would have happened if, over 17 years, you had bought a portfolio of the 30 stocks that ranked highest on these 2 combined metrics, and rebalanced it every year? The results were stunning. The magic formula would have returned an average of 30.8% per year, more than doubling the market's return of 12.4%. He published his findings in a wonderfully simple book, The Little Book That Beats the Market. He even created a free website to help regular people apply the formula. But then he discovered something fascinating, and a little disheartening. Even when handed a simple, powerful, and proven strategy, most people couldn't stick with it. The magic formula, like any strategy, went through periods where it didn't work. During those times, people lost faith and abandoned it, usually at the worst possible moment. They also shied away from the ugliest-looking stocks on the list, even though those were often the biggest future winners. Their emotions got in the way. This led Greenblatt to a profound realization. For most individuals, the best strategy is not the one that's going to get you the highest return. Rather, the ideal is a good strategy that you can stick with even in bad times. Simplicity is powerful. But it's not enough. You also need a deep-seated conviction and the emotional resilience to stay the course. And what gives you that conviction? Often, it comes from a philosophy that goes beyond just making money. It comes from playing a different game altogether. This brings us to our final story, the excellent adventure of 2 remarkable investors named Nick Sleep and Zach Zakaria. Their journey reveals that perhaps the richest rewards of all go to those who have mastered the art of playing the long game. In 2001, Sleep and his friend Zakaria started an investment fund called the Nomad Investment Partnership. They didn't want to build a giant firm or get rich off fees. Their ambition was different. They wanted to see if they could run a fund in the most high-quality way possible, to prove that there was another way of investing and another way of behaving that didn't involve all the Wall Street bollocks. Their specific goal was to turn £1 into £10. A tenfold increase in their fund's value. That was it. To do this, they realized they had to play a long, simple game. And the first step was to eliminate almost everything that other investors obsessed over. They ignored macroeconomic forecasts about the economy or interest rates. They ignored the short-term news cycle. And, most radically, they threw away all the research reports that came from Wall Street brokerage firms. It really was all just gossip and bits of nonsense, says Zakaria. By shutting off all this noise, they were free to focus on what truly mattered, understanding businesses with a time horizon of 10 or 20 years. They called this destination analysis. They asked, what is the intended destination for this business? And what must management be doing today to raise the probability of getting there? In their early years, they were classic cigar butt investors, buying deeply distressed companies for a fraction of their value, just like the early Ben Graham. But they soon realized this had a problem. Once you made your profit, you had to find another cigar butt. It was a lot of work. They evolved. Influenced by Charlie Munger, they shifted their focus to finding truly great businesses that they could own for a very, very long time. And in this search, they stumbled upon a powerful, unifying business model. They called it Scale Economies Shared. Here's how it works. A company gets bigger and becomes more efficient. These efficiencies lead to cost savings. Now, the company has a choice. It can either keep those savings as extra profit for itself, or it can share them with its customers in the form of lower prices. Most companies choose to keep the profits. But a very special few, Sleep and Zakaria found, consistently chose to give the savings back to the customer. Their primary case study was Costco. Costco operates with razor-thin margins and makes almost all of its profit from its annual membership fees. It passes on almost all of its cost savings to its members. Wall Street analysts hated this. They thought Costco was being too generous to its customers and not greedy enough for its shareholders. But Sleep and Zakaria saw the hidden genius in this. By offering incredible value, Costco created fanatical customer loyalty. Customers kept coming back and spending more. This generated more scale, which led to more savings, which were passed back to the customer in a virtuous cycle. As Sleep described it, increased revenues begets scale savings, begets lower costs, begets lower prices, begets increased revenues. Costco's size, instead of becoming a burden, became a massive competitive advantage. They saw this same model in other durable winners: Walmart in its early days, Southwest Airlines, and Geico. And then they found the ultimate practitioner of scale economies shared: Amazon. When Jeff Bezos launched Amazon Prime in 2005, offering free 2-day shipping for a flat annual fee, Sleep and Zakaria had a moment of revelation. They realized Bezos was playing the exact same game as Costco, but on a global scale and supercharged by technology. He was consciously choosing to sacrifice short-term profits to build a fortress of long-term customer loyalty. "Oh my God, I know exactly what game they're playing here," thought Sleep. Amazon suddenly became Costco on speed. They made a huge bet. They put 20% of their funds assets into Amazon, at around $30 a share. A quarter of their clients immediately pulled their money, terrified of this concentration. But Sleep and Zakaria had a conviction born of deep thought. Over the next decade, their portfolio became incredibly concentrated. At one point, it consisted of just 3 main holdings: Amazon, Costco, and Berkshire Hathaway. They held these businesses year after year, through market crashes and wild volatility, with heroic patience. They understood that the true source of great returns comes not from what you buy and sell, but from what you hold. The result? Over 13 years, Nomad returned 921% after all fees. They had achieved their goal. They had turned £1 into more than 10. In early 2014, they dissolved the partnership and returned all the money to their investors. Their great adventure was complete. Their story is the ultimate testament to the power of deferred gratification. In a world obsessed with speed and instant results, they built their success on patience. They understood that the greatest rewards often come to those who are willing to wait. This journey through the minds of the world's greatest investors, from Pabri's cloning to Templeton's contrarianism, from Marx's humility to Greenblatt's simplicity, from Ivaar's resilience to Sleep and Zakaria's patience, reveals a common thread. It's a way of thinking that is rational, disciplined, and long-term oriented. But as William Green discovered, these principles don't just lead to wealth. They lead to a better life. And no story illustrates this more powerfully than that of Arnold van den Berg. Van den Berg was born into a Jewish family in Amsterdam in 1939. When the Nazis invaded, his parents went into hiding. To save him, they gave him to a teenage girl from the Dutch resistance, who smuggled him out of the city to a Christian orphanage. He was 2 years old. He spent the next 4 years in that orphanage, believing his mother didn't want him. He almost died of malnutrition. "It was," he says, "a miracle that I made it." His parents survived the Holocaust, but the family was shattered by trauma and poverty. He grew up feeling angry, afraid, and, after a psychologist suggested his brain may have been damaged by malnutrition, not very smart. He struggled in school and ended up in the army, then selling mutual funds door to door. He was lost, until 2 things changed his life. First, a psychiatrist helped him understand the incredible sacrifice that the teenage girl who saved him had made. He told him, "If your principles are more important than your life, you sacrifice your life." This gave Van den Bergh an intense desire to live a life worthy of that sacrifice. Second, he discovered the writings of a philosopher named James Allen, who taught that our outward circumstances are a reflection of our inner world. "By your own thoughts you make or mar your life," Allen wrote. Desperate to change his circumstances, Van den Bergh made a total commitment to change his character. He became a lifelong student of wisdom from all spiritual paths. Honesty and integrity became his guiding principles. And slowly, painstakingly, he rebuilt his mind, replacing the negative thoughts of fear and inadequacy with thoughts of strength and purpose. He also discovered Ben Graham and the principle of margin of safety. It resonated with him deeply. It was a philosophy of survival. He started his own investment firm with no money, working out of a spare room, and built it brick by brick on this foundation of discipline and integrity. For over 40 years, he has compounded money at an admirable rate. But that's not what makes his story so powerful. He lives a simple life. He has no interest in big homes or fancy cars. A vegetarian teetotaler, his passion is yoga and reading. He has given away millions to charity, especially to help abused and neglected children. The greatest blessing his money has given him, he says, is the ability to help others. One day, he was feeling down. He was struggling in his business. He started comparing himself to other, more famous investors. He thought, "I'm a failure." Then, as he was driving, he started listing all the things he was grateful for. His wife of 50 years, his children, his friends, his health, his freedom. And in that moment, he says, it was like God was in the car. He said to me, "Arnold, what the hell are you bitching about? I've given you everything. You're the richest guy in the world and you don't even know it." And that is the ultimate lesson of this remarkable book. True wealth isn't just about the number in your bank account. It's about freedom. It's about security. It's about having the ability to help others, to pursue your passions, and to live a life aligned with your deepest principles. It's about building an inner fortress of resilience, wisdom, and gratitude that can withstand any storm. It is, in the end, about becoming not just richer, but wiser and happier. Commentary. As we come to the end of our journey through richer, wiser, happier, it's worth taking a moment to reflect on the sheer depth of the wisdom that William Green has distilled for us. This isn't just a collection of investment tips, it's a manual for rational living in an irrational world. What I find most powerful about this book is its central, recurring theme: the quality of your life ultimately depends on the quality of your thinking. The great investors aren't just playing a different game, they're operating on a different mental plane. They have cultivated habits of mind that protect them from the emotional roller coaster and short-term noise that derail most people. Think about the core ideas we've explored. The humility of Monish Pabry, who understood that it's better to clone genius than to invent mediocrity. The courage of Sir John Templeton, who taught us that the greatest rewards are found at the point of maximum pessimism, a place you can only go if you're willing to be lonely. The profound wisdom of Howard Marks, who embraces uncertainty and reminds us that because the future is unknowable, we must prepare, not predict. The disciplined resilience of Jean-Marie Everard, who showed that you win by not losing. The elegant simplicity of Joel Greenblatt, who cuts through the complexity to find the essential truths. And the heroic patience of Nick Sleep and Zach Zakaria, who demonstrated the superpower of deferred gratification in an age of instant everything. These aren't just investment strategies. They are life strategies. How many of us have the discipline to truly play the long game in our careers, our health, or our relationships? How many of us have the courage to stand by our principles when the crowd is running in the other direction? How many of us have the humility to admit what we don't know and to systematically learn from our mistakes? This book holds up a mirror to our own behavior. It challenges us to be more rational, more patient, and more humble. It reminds us that the small, incremental gains, compounded over decades, lead to extraordinary results, not just in our portfolios, but in our character. So, how can you start applying this wisdom today? Let me suggest 3 simple actions. First, start a mistake journal. This is a practice inspired by Charlie Munger. Every time you make a mistake, in an investment, in a decision at work, in a personal interaction, write it down. Don't judge yourself. Just analyze what happened and what mental error or bias might have led to it. This simple habit of self-reflection is one of the fastest paths to getting consistently not stupid. Second, define your circle of competence. This is a core idea from Buffett. Take a piece of paper and write down the subjects, industries, and businesses that you truly understand with deep fluency. Be brutally honest. Your circle might be very small. That's okay. The goal is not to have the biggest circle, but to know exactly where its boundaries are, and to have the discipline to stay within them. Third, practice the art of inversion. The next time you face a big decision, don't just ask, "How can I achieve success?" Start by asking, "How could I guarantee failure?" List all the things that would lead to a disastrous outcome. Then, simply work to avoid them. This simple shift in perspective, from seeking success to avoiding failure, is one of the most powerful mental tools for improving your odds in any endeavor. That was a summary of Richer, Wiser, Happier by William Green. We've hit the highlights today, but I'll be honest with you, a summary can only take you so far. The real magic happens when you hold the book in your hands and let its stories sink in. It's in the quiet moments, when a particular phrase or a simple anecdote from one of these great investors hits you in a way you didn't expect. This podcast is designed to help you decide if this book is worth your time and attention. If anything we've talked about today has resonated with you, I wholeheartedly encourage you to grab a copy. Reading it isn't just about learning. It's an experience that can genuinely change the way you think about money, decisions, and what it truly means to live a good life. There's a link to the book in the description below. Also, if you found this summary valuable, I would be incredibly grateful if you would hit that like button and subscribe to the channel. It lets me know that this work is making a difference, and it ensures you won't miss our next journey into another life-changing book. Let's keep learning and growing together.